Hello and welcome into the KE Report. Shad and Corey here, getting an update from Christopher Aaron, founder of iGold Advisor and senior editor at the Gold Eagle website. And Christopher, it's always great to get you on periodically and just see where your mind's at as far as the technical readings on the precious metal sector. We've had a big run since we talked last. I think we last talked in August. And so now here in October at the end of the month, gold has continued to have a series of breakouts to higher and higher highs. We're now in the mid 2700s. And you had mentioned earlier in the year when we talked, and even in a couple prior interviews, that you had some targets for gold that extrapolated out of that rectangular box consolidation back when it got down in 2022 to the 1618, 1620 level. And it kind of extrapolated out to where we're at today. So I guess kicking things off with the precious metal gold, where are you looking at it now in its journey on the charts as far as the levels it's achieved? Is there any juice to run, or are we getting near the top of this cycle?
Yes, Corey and Shad, thank you so much for having me back on the show. Let's talk about gold itself. You are correct. We had a target going all the way back to late 2022 when gold was trading at 1700 per ounce. I had calculated an amplitude derived target of 2,535. That was the amplitude of the preceding consolidation. We had a false breakdown in late 2022. False breakdown sets the stage for a positive resolution. Eventually, we can then take an amplitude measurement of the consolidation, add that onto the breakout point, because all things considered, we're going to have that much amplitude of short sellers and hedgers, whether they're commercial users, whether they're nefarious entities, all of the above, that are going to be covering their short positions once the breakout happens. The breakout happened in March of this year, 2024, above 2,075 per ounce. We add the amplitude onto the breakout point. That gave us an official target of 2,535. That target was hit just a few months ago in August. Now, I've always said that when an official outstanding long-term target is achieved, it does not necessarily mean that the final top is in long-term or even for that wave. It can be, in fact, a pivot point. And we saw gold kind of consolidate below 2,500 for about 4 months, just in that region, the low 2,500s there, leading all the way into August. So the market was clearly respecting that target that I had there. Now, the interesting thing is then over the last 4 months, call it April, May, June, July, there was a little inverse head and shoulders pattern that developed in a slightly upward channel. Every once in a while, an inverse head and shoulders pattern can actually represent a continuation. We saw this from 2008 to 2010. We saw this again here, April through August of this year. That broke upward in mid-August. That had an amplitude that led us to a subsequent short-term target of 2,680, 2680. So 2680 was my final target for gold, the way that the charts stood as of just a couple weeks ago. This final target, 2680, was achieved mid-September. So it's important for listeners to understand where I am right now as a technical analyst of the markets, and right now focusing on precious metals. At this point, I have no basis, no chart-based evidence with which to expect higher gold prices. I have no chart-based evidence for that. However, I am not saying that this means gold has to top right now. It is entirely possible, as we saw with the 2535 target, for gold to continue trending higher. It's just that I don't have any basis on the gold chart itself to project that. So therefore, what I have to do is look at other markets, look at related markets, look at ratios, look at the US dollar, look at silver, look at the miners, look at the Dow to gold ratio. I have to look at all these other things and ask myself, when I'm looking at these other aspects that are related to the gold price, do I have evidence that would suggest that perhaps gold wants to continue trending higher, even though on the gold chart itself, I have no basis for that? And so that's where, for example, if I turn to silver right now, which I think is probably what we would talk about next, I look at silver and I say, you know what? Just here in the last 5 days, silver has broken higher from a nice 5 month consolidation above its May peak. The May peak was $32.50 in the spot market. Silver has just broken above that level. And quite similar to how we were able to make a projection for gold going back from late 2022 based on the amplitude of the 4 year consolidation, we can do the same on the short run here for silver. So silver just broke higher from a consolidation that had an amplitude of $6.15. We are able to add that onto the breakout point and say that there are going to be short sellers, there are going to be hedgers, commercial users, companies that entered into streaming agreements at previous prices. They're going to cover those shorts. You're going to have some nefarious entities that have to cover their shorts as well. It's all of the above. It's never one group. It's all the groups. And so for silver, on the short term, let's call it intermediate term. Intermediate term, I'm usually referring to a period of time less than 1 year. So call it 3 months to a year. For silver, I have an official higher target at this point of $38.65. $38.65 is my official target. So we put everything together here, and I say, well, if I have no official target for gold at this point, because it's already achieved all of my targets, I mean, for crying out loud, we're $700 higher than where we were earlier this year in gold. It's been an excellent run. It's achieved all my targets. I'm very pleased to see that. I have a higher target still for silver by about $5 more. What that would tell me is I have a hard time seeing gold enter a bear market, let's say, while silver still has a higher target. So all things together, I still think over the intermediate term, the next several months, perhaps into a year from now, this time next year, I still think that we have a generally supportive precious metals markets where the metals could be trending higher, especially for silver. Maybe this is the time where silver outperforms gold and gold just sort of consolidates. And then I think we need to talk about whether it's 3 months from now, 6 months, 12 months from now. I think we have to take that giant step backward at that point, and we have to look ourselves in the mirror, fair and square, and say, is this it? Is this the end of the bull run that began 10 years ago or 25 years ago, depending on how we want to define the start of bull markets here? But even if we use the more recent figure, I mean, gold has nearly tripled from when I started publishing in 2015. Of course, I've been investing in these markets since 2007. But since I started publishing professionally, gold has nearly tripled. Incredible. Nothing moves higher in a straight line forever. Could gold keep going higher to some of those, gold bug type targets, 5,000, 10,000? It could, but it also could not. And I'm not saying anything can happen here and it's just a toss of a coin. What I'm saying is there are defined levels on the charts that as gold approaches those levels, we have to let the market show us. And then we have to align with what the market actually does at that point. Because if we don't, we are going to get clobbered and we're going to miss out on the major trend that develops here after silver hits this target and after gold has the final wave of the current run.
Christopher, that's a great outline there. Gives us a little food for thought as we watch this bull market. It is a bull market. People are starting to feel pretty good about this bull market. Sometimes that means that it is the end of it, but bull markets can also go on longer than individuals think. One aspect that we talk to you about all the time is the relationship between gold to the Dow, or even broadly the US equity markets. One thing that's been so curious about this run in gold, this bull market, is that it hasn't really outperformed the Dow. That's a chart you watch closely. I know that is critical to that whole concept of, will this be a longer term bull market? Break down what you're seeing in that chart, please.
Yeah, exactly. So let's update this. If you're new to understanding the ratio between the Dow to gold, of course, what we're talking about is the largest stock market index, the longest dated stock market index in the Western markets, going back to the 1800s. And of course, we're talking about the longest store of value in human history. So we're talking about, and for everyone who says, well, the Dow is only 30 stocks, it's not the best index to use. Trust me, it tracks with a 98% correlation with the S&P 500 or with the Wilshire index. So it's perfectly fine to use the Dow to compare it with gold. When we look at the relationship between the Dow and gold, right now it's trading at 15.2 ounces of gold required to purchase one share of every company in the Dow Jones. 15.2. Corey, you want to guess what level it was trading at in 2015 when gold was about $1,000 per ounce?
I don't need to guess. You've already told me. It's pretty much the exact same.
Yes. Okay. So, in other words, it has been 9 years. The gold price has nearly tripled in the last 9 years, yet the Dow to gold ratio is exactly the same as what it was in 2015. So, what that means is that as gold has tripled in value, so has the Dow Jones Industrial Average. It's not only the fact that that has happened, which is interesting, it's the fact that this is the first time, this is the first gold bull market in which this has happened ever in all of freely traded history. The 1970s gold bull market, in which gold moved from 35 up to 850 per ounce, saw the Dow to gold ratio compress from 25 down to 1 in favor of gold. The 2000s bull market, which saw gold move from 250 up to 1900, saw the ratio compress from 44 down to 7 in favor of gold. So in other words, stocks lost almost 80% of their value relative to gold in that 2000s bull market. This bull market, price of gold has tripled over the last 9 years. If that's not a bull market, something tripling in price in 9 years, I don't know what a bull market is. So I think we can all agree that this has been a bull market over the last 9 years, but the ratio between Dow and gold has moved sideways. Again, this has never happened before in the history of freely trading markets. First time, we're living through an anomaly here. First of all, this is why, even though we're talking about gold hitting new all-time highs, silver breaking out, this is why the valuations are so depressed across many of the gold mining stocks and the silver mining stocks. You know, I'm seeing a lot of companies that have 2, 3, 4, 5 million ounces of gold in the ground that are trading at or near 52-week lows right now, as gold itself is at all-time highs. The reason for that is the general investor has been perfectly content to just park their money in Dow or S&P 500 index funds or world stock index funds. They have seen no need to move into the precious metals market. And so the valuations on the speculative end of the sector, we're talking silver and we're talking the gold and silver miners, remains depressed, even though the metal itself has tripled in the last 9 years. Now, this sideways type price action between the Dow and gold has actually been forming an incredibly beautiful, I use that word because as a technical analyst, I like to see precise looking patterns. Anytime I see a precise looking pattern, I might call it a nice or a beautiful pattern because it's very clear to see. This relationship between the Dow and gold, and I'll provide this chart. We'll do an updated version of this chart below the video here. This has been forming this incredibly precise triangle pattern for the last 44 years. And we are within the final 10% of this pattern. And these triangle patterns, I've studied these throughout history. These triangle patterns never wait to the exact apex of the pattern in order to resolve. The exact apex of this pattern is mid-2027. But here we are about 10% away from the apex now. This thing is going to break here. My expectation is that this is going to break within the next several months, possibly into mid 2025, this time next year. But this thing is not going to wait very much longer. And so, when I said earlier that after this wave in silver, after this wave in gold, we need to let the market show us. We need to sort of get off of our ego trips and move away from listening to the fundamental storytellers. Trust me, I listened to plenty of storytellers back before the crash of 2008 who told me that due to all the problems in the banking sector, gold and silver could only go higher. And what happened? Silver fell more than the general stock market in the crash of 2008. And the gold and silver miners fell more than the general stock market in the crash of 2008. So we all know the individuals that I'm talking about. I don't need to mention any names here. But I told myself after the crash of 2008, and especially after the peak in 2011 in precious metals, that I would never listen to the storytellers ever again in my investment career. If this is the first time you're going through one of these precious metal cycles and you find yourself listening to a lot of analysts who are not providing charts, not providing actual data, but instead they're sort of going on these monologues, talking about stories about what will happen, you really have to decide if you want to receive this education either by paying for it with the value of your portfolio because you listened to the storytellers and the pumpers, or if you want to branch out now and start paying attention to more data-based analysis at this juncture. Because when we fast forward 3 to 12 months from now, when this Dow to gold ratio breaks, if it breaks in favor of the Dow, we had better realign our expectations on precious metals, on commodities, and on global markets. If this thing breaks in favor of the Dow, it is telling us that the problems with the banking systems and the problems with fiat currencies, although they are real, they are not the most important problems in the world. It's like saying, I have a cold. Yes. Is that real? Yes. I was just traveling. I was just on an airplane a few days ago. I came down with a cold. Is that real? Yes. But simultaneously, there is a hurricane barreling straight at my house. So if we as investors are going to be so short-sighted as to say that the cold is the most important thing when there's a category 5 hurricane coming straight at you, hey, go ahead. Worry about taking your Sudafed and stuff like that when there's a much bigger issue right at your doorstep. What I'm saying is the Dow to gold chart, whichever way this breaks in, is going to be the single most important indicator for the global markets for 2 to 3 decades after this thing breaks. So prepare now, enjoy the higher target that we have for silver, enjoy the fact that gold should trend higher while silver is achieving its higher target. The miners should trend higher still. There should be a little bit more juice in them. But the time to prepare for a major macro shift is not when it's barreling down at your door. It's ahead of time so you can think about what this actually means, not only for the markets, but for yourself as a sovereign human being.
Well, Christopher, that's a lot to digest, but I know that we've talked about the importance of this chart as the most important chart to be watching for the longer term signal. I do want to get to the mining stocks, but first I just got to ask you a follow-up. We've had some other intelligent data-based investors on the show, technicians, and when they look at the setup, even when they look at the equities, they believe that we have not been in a bull market, even though gold has tripled and even though, things are well off their lows from 2016 in the mining stocks, because it hasn't broken out in real terms against the Dow or against the S&P. And they believe that we're just now entering the window where we do, if it breaks in that favor, that we would see gold get to those higher gold bug targets, 5,000, 10,000. Now, so if this chart that you're looking at resolves where gold is to break out, I guess that's the scenario you're looking at. But we also have had people point out that in prior cycles, gold went up usually 7x, 8x. So when you look in the 70s or you look at 2000 to 2011, you had a range of, let's say, 7x or more that gold went up. Is it possible that the 3x move that we've seen is still only the earlier innings in a scenario where that chart resolves to the upside for gold, not for the equities? Could we still see a 7x move, from 1,000, let's say, to 7,000, or is that a pipe dream?
It's possible. And as someone who currently has a business focused on precious metals, I mean, nothing would make me happier because it would be very easy for me to continue growing this business if we have that kind of resolution on that chart. However, we have to let the data show us. We have to let the chart show us. And I would actually go back and challenge those figures. I mean, if we start from $35 per ounce in 1970, 71 up to 800, 850, we're talking about a 24, 25x move. And then if we talk about 250 up to below 2000, we're talking about a little less than an 8x move in the 2000s bull market. So in percentage terms, it was roughly a third. The 2000s bull market was only one third as powerful as the 1970s bull market. And so here we are. So if it was an 8x in the 2000s, we're looking at a 3x now, nearly a 3x. That's also, again, about one third of the previous cycle. I mean, so the cycles seem to be getting less powerful as we go on. So the evidence shows that. Again, if this ratio was going to break in favor of gold, and right now the level that I'm looking at is it's not that far away. It's actually just around 14.5 on the Dow to gold ratio. That would show me that it's really resolving in favor of gold. Right now, the ratio closed at 15.3. So, I mean, it's not that far away, but it's been extremely elusive. Again, nothing would make me happier. And then what I would say is that we are entering one of those periods of time where, let's talk about it for the next 3 to 5 years or so, the problems in the banking system and the problems with fiat currencies are in fact going to be the most important storm on the horizon. And again, as someone who currently invests mostly in precious metals, that would be totally fine for me. I'm just saying that we have to see it on the chart. If we don't see it on the chart, to stay married to that kind of narrative, it's going to result in an extremely painful outcome for our portfolios.
So, Christopher, tying this into the underlying equities, then, look, even on the charts, it's something that the charts are showing us is that these equities have, for the most part, underperformed gold. Gold's hitting all-time highs, GDX, GDXJ, really whatever kind of chart you want to look at that baskets up these equities, they're nowhere near their all-time highs. Individual stocks are, but broadly, the equities have drastically underperformed the metal. That brings up this whole concept of the catch-up trade. We've been hearing it for at least 5 years, maybe even more than that. Once gold's been moving up, just how undervalued these stocks are. How do you take that as a technician?
Yes. And, we have seen a bit of a catch up in some of these equities, certainly not all of them, and not enough of a catch up to make up for the previous several years of underperformance. So there can indeed be a catch-up wave that happens in the gold and silver miners. And perhaps that catch-up wave has further to go. I'm looking right now at the GDX as having just gotten back to the 44 level recently. It's closed below that today, back down at 41 and change. But recently it's gotten back to that 44 level, which is very close to the 2020 peak. So there is going to be some resistance here simply because some of those sellers who originally bought in 2020 are now going to exit the market at break even. There is going to be some resistance here. However, I'm open to the possibility that if the GDX can start breaking above 44, 45, let's call it the 2020 peak, that it could have a serious further advance to go, maybe up to 56 on the GDX or perhaps even up to the mid 60s. And that would be a very nice wind at our backs as gold and silver mining investors here over the next 3, 6, 12 months. That would be very nice. So we have to watch that recent peak on the gold chart. And so that would fit in, especially with the narrative of, hey, look, we talked about silver has already broken out above its May peak. Silver still has a higher target. Silver tends to be the more speculative of the precious metals. So if silver has a higher target, it makes sense that the other speculative end of the precious metals still could have further room to go to the upside. That does make sense. I would say the warning signal that we just have to keep in mind, I just talked about the fact that the GDX is hitting overhead resistance around 44, 45. The peak from 2020. Think about that for a moment. GDX has just gotten up to its 2020 peak. gold price is $700 higher than its 2020 peak. So what that means is that there has been, even though, yes, we could have more to go on this wave, there's this warning signal. And this underperformance, this $700 higher move in gold with basically the GDX just getting back to where it was a few years ago, I do want to let investors know this is a similar type of signal that we saw in 2010, 2011, before the entire sector topped for a multi-year bear market to follow. So again, back to the Dow to gold. I think if the Dow to gold ratio were to break lower in favor of gold, nothing would make me happier. And then we could talk about there being a really more dramatic wave setting up in the gold and silver miners as, let's say, a final couple of a year wave. But we don't have the confirmation of that yet. And if the ratio breaks in favor of the Dow, then this underperformance in the gold and silver miners would be looked at in retrospect as the warning signal that that was in fact going to happen. So we absolutely need to continue following this on a weekly and a monthly basis so that we are aligned with the proper direction of these markets. Not try to tell the markets what to do, but align with the actual outcome of the markets.
Well, Christopher, just before we wrap up, I don't want to end it on a too down of a note for people that are maybe worried about what could happen. Obviously, what happened after 2010 and 2011 was a pretty rough bear market from 2011 down to 2015 and in January 2016 for the mining equities. But there was also a different period of time, and you've highlighted it before in a previous call. We don't have time to get into the long version, but just quickly tell us about what the end of the 1970s looked like, particularly after that long pause in the mining stocks where they were consolidating, and then 1978 to 1980, there was that final upswing. So if we see the Dow gold ratio finally resolved to the upside, could we get a 1978 to 1980s type of move? Maybe just as a happy thought for people listening in.
I mean, yeah, that's the crazy thing. If we look back at the 1970s cycle and we ask ourselves, so imagine, gold is consolidating for 4 years below $200. And that was the former all-time high, 200 from 1974. And so it's consolidating for 4 years. So no one on planet Earth has ever seen the gold price above $200 per ounce. Not ever. And the miners had been underperforming for those 4 years. As gold moved sideways, a lot of the miners lost 60, 70, 80% of their value, the same way that they have here over the last 4 years. And so then gold breaks above $200 per ounce the end of 1978. I mean, what would the average person really be thinking? I would suspect that the average person would say, hey, this is an all-time high. 200 was an all-time high. We've just broken above it. Hey, maybe we'll get to 250. Maybe we'll get to 275. Maybe we'll even get to 300. Call it a 50% move above the former all-time high, right? What ended up happening? Gold broke higher from 200 and then did a quadruple. It went to above 800 in the final 15 months. And those miners that underperformed for that entire 4-year consolidation, a lot of those miners moved higher by over 1,000% in that final wave for gold. Now, that's the sort of silver lining here. We look at it from a big picture perspective, and we know that the 1980 peak in gold was not sustainable at the time. I mean, it was hit for a few days, and then it came back down quite rapidly to about $300, $350 per ounce. But still, some of these miners moved higher by over 1,000% in the final wave in 1979. So if something of a final wave is setting up now, it is entirely consistent with the history of these cycles that the most dramatic moves higher in the gold and silver miners can happen here in the final part of this last wave, which, I mean, you judge by the silver price having broken out here, that could still be ahead of us. And I just want to say, from a strategy perspective, the way to play a final wave is not by leveraging higher as the wave is unfolding. The way to play a final wave is by systematically, slowly and surely taking profits off the table so that you are ensured that you do not leverage higher into the final peak, because that could be catastrophic. But you take profits as this thing is going higher. No one will catch the exact top with 100% of one's portfolio, but you take some profits systematically every several weeks, every several months, and you will come out good on this final wave.
That's some sound advice there, Christopher. And man, I really appreciate you breaking down your longer term view of gold, silver, what's been happening recently with silver, possibly taking gold up with it because it's already above the target you had for gold. And I think some of this has even happened quicker than maybe some of us were expecting. But at the same time, that most important chart we will put down below this interview where you can look at the resolution of this triangle pattern on the Dow to gold ratio. And we'll obviously keep following along with it. It's definitely going to be breaking in the next year to 3 years. We just don't know when, but it's going to be exciting to keep following along. And Christopher, we'll get you back on in a couple months and just check in to see where things are at. And if people want to follow Christopher's work, definitely click on the links below this. It takes you over to his website, iGold Advisor, but it also takes you over to the Gold Eagle website. And looking forward, as always, to our next conversation.
Thank you, gentlemen.